I'm here with Pengana's Emerging Companies Fund co-founder and co-portfolio manager Ed Prendergast. Ed, you've run a really successful fund for a number of years now, but I heard you make a comment the other day which I thought was really interesting about investor psychology, and that actually the recent volatility that we've experienced sort of since the middle of the year has really knocked the scabs off the wounds of the GFC. So I was interested to know what that means.
Sure. Well, I guess most investors are still heavily scarred by the GFC. It's 7 or 8 years ago for us, so it feels like a long time ago. But for most people, the destruction in value was just so overwhelming that and I don't think your average investor didn't quite return to the asset class, particularly shares, until sort of the dust was seen to settle. But then we had Dubai 2 or 3 years ago, then we had Italy, Spain. All these things have created sort of blips and are pushing people back and reminding them of how bad it got last time. And I guess the point we make, with the recent volatility is it's just another bad advertisement for the asset class. And volatility to us is not necessarily a bad thing. It's short term, it's distracting, but it doesn't actually mean the values are changing that much. And for us, in fact, if volatility scares investors away, it actually creates opportunities for stock pickers like us, because share prices tend to move irrationally rather than due to actually underlying value, the things that affect their value. So you might see something fall 20% just because it's a bad week in the US and there's no change in the value of the business, so we would buy more, for example. And just that hysteria tends to open up opportunities. So,
continuing with the medical analogy, when will the scars be fully healed, do you think?
Oh, it's hard to know. It was such a deep sort of when it fell apart, they were such deep scars. It depends on the individual investor and their experience, but certainly the fact that the headlines are still the newspapers and everyone they do sell papers off the back of it so heavily, name the number of billions of dollars that was destroyed in value in one day, and everyone's like, oh, it's happening again. It means that it is pretty ingrained in people's memories.
And what should individual investors do to be alive to that sort of psychology around how impactful the GFC was for them?
My personal thoughts would be just to look through the volatility, to deal with facts, and that the GFC was based on facts. The banking system collapsed, and there were serious faults exposed. But then when you get sort of pictures, of China and its volatility in the US market and those sorts of things shorter term, I would wait for a lot more signs that there are serious problems emerging. It's not to say it's a perfect world though, because the US is its interest rate strategy is the sort of thing that created the first GFC, free money for everyone type situations. But as long as you've got a diversified portfolio and if your time horizon is long enough, then short-term volatility shouldn't mean a hell of a lot.
So I think we'll take from that you're guaranteeing that we're not going into the next GFC. But seriously, that it is important that we recognise that yes, we're still all investing in the shadow of what was a deeply emotional experience as well as being a financially impactful experience. But that in lots of ways where we see volatility, we should be embracing it for the opportunities it delivers.
Yeah, as long as your time horizon's long enough.
Yep.
Yeah,
all
absolutely.
Right. That's really helpful. Thank you very much.